Hey guys, welcome. Today we had a fantastic textbook perfect trade and we're gonna break it down for you. So we are on the micro ES futures contract, but it works the same with the ES or with the QQQ if you are trading equities. This morning, Wednesday, March 26, 2025. At 8:10, this is where we are at. I'm gonna break it down, the trade we took, and our analysis. You can check it out live. Every morning we are live on YouTube from 7:30 a.m. Pacific to 9:30 a.m. Pacific. We archive everything and we do some recap on our other socials that you can check out down below in the description. All right, so first and foremost, we love to display some indicators, the volume and some exponential moving averages, the 20, the 50, and the 200. Every day, almost every day, there is one of these EMA that act as a line of resistance, if you will. The price will bounce from one of these three. So that's important. Then we like to place two significant levels, the previous day high and the previous day low. And we treat them as zones or areas, not single line, because trading is not a perfect science. So the way I like to do it, there is other ways, but I like to take the 15 minutes. I go back one day. I place the high of the previous day and I place the low of the previous day. And then I place a rectangle from this high of previous day up to the next pivot point. This one, for instance. Okay? I do the same down below. This one. Okay? And obviously I extend them so I can see them on the current day. So those are my absolute best and preferred levels. Then I look on the scale here if I have some rounded numbers. Here we see 5800. So I will place the 5800. I like to take a white line. Okay. And for now, that's enough in terms of levels. We'll see that we'll place other levels right after. I'm back to the 5 minutes. I like to trade the 5 minutes, sometimes the 2 minutes as well. So we are doing a small account day trading challenge. We started with $2,000. We are at $4,000, so we doubled the account. And therefore, we start trading at 7:30 a.m. Pacific. We don't trade any other trades. Everything is recorded live. Okay, so this morning, we see that. What do you see? You see that we had some sort of consolidation at the previous day low. At this point, it's really hard to take a trade. You have no clue. Will it bounce? Will it break through? You don't know, so you wait. Then it went down, and we see that we break out of this significant level, the 5800. We couldn't close below it, so it's a fake out. And then again, consolidation right there. But this consolidation is slightly different because it's a slanted trend line. Okay, so it's a counter trend line in a downtrend. Okay, and now you can place another trend line starting from this point and then to this pivot point. Okay, and that's where things started to be really interesting, and that's where we entered a really good trade. So we see that the price has rejected, after multiple attempts, has rejected the previous day low. That's one thing. The second thing is that it tried to break out of the 20 EMA 1, 2, 3 times, and it rejected as well. So there is a confluence here. We have the previous day low and we have the 20 EMA that act as a defense, as a line of resistance. And now, that's the beauty of this trade. You have in front of your eyes a perfect bear flag forming. You have this pole here that is long, and then you have an ABCD pattern right there. Okay. The way we like to enter these trades, there are several ways, but the way we like to enter is to wait for a clear rejection, we talked about that, and to have the next candle closing red. And that's when we place our order. So the order is right there for a tight stop loss above the 20 EMA. Some other people may say, yes, but you need to wait for the breakout of this trend line. Yes, that's valid, but in that case, I would suggest to wait for the retest, because oftentimes you have a fake out and rejection. Especially here, you have this level. So if you want to wait for the breakout, you need to wait for something like it breaks, retest, and then go lower. It's a question of optimizing the risk to reward ratio. If you enter here, you have a tighter stop loss, and depending on how you size, yes, you can pretend to a higher risk to reward ratio. Anyway, so I will use this tool to help you understand our way of thinking. When we see this candle closing, we place a stop entry, a short, and a stop loss right there. But we have a third things to determine is what would be the target. So the way we think about it is again in terms of confluences. We want at least two levels, two things to say, okay, this is realistically where we think the move will go. I will talk about how we trim, how we scale in, or how we scale out. All right, so here we see the formation of a bear flag. When you have a bear flag, usually this pole, you duplicate it and you can copy it from the previous pivot point. Okay, so that would be the target. So that's one. Now I like to see if we have other horizontal level like these ones. So for that, you can go back in time. You can change time frame if you want. And here we see this one. Okay, so this would be one level. Then we see a second one right there with a long bottoming tail. So in that case, I take from the wick up to the body. That's another. And while we are at it, let's go back even further. And we see that we have here another one. Okay. We have another one right there. And we have a gap here. Interesting. So gap are interesting as well, because if you bounce, it's okay, but if you don't bounce, usually it closes the gap. So it's a huge flush, I should say. Okay, anyway, I'm not sure we're gonna go this far. Okay, so in terms of realistically, this trade could go somewhere here. I say somewhere because it's not an exact science. If you take the pole here and this pole, it's right there. But we have a significant level. Okay, so that's the line of thought, if you will. But on the way to this final target, because you never know, you need to trim. Where do you trim? Here you can trim here in this area, because we might attempt to break out of this 5800 level, but we might fail as we did here. So you want maybe to trim here, okay? You trim in this area. However, if we go down and if we close below this level, most likely we're gonna flush or go to this level. All right, but if we go to this level, you would have a perfect bear flag. It's not the final move, you never know. So usually we let some contracts run and then we would trim and trim and trim. So what I'm giving you is a way of thinking, and it's a playbook, if you will. So we have playbooks that we print and we stick to them. Everybody has their own strategy, okay? There is nothing that works 100% of the time. It's just a question of expectancy and good risk management, and try to optimize your trade with rationality. In fact, there is nothing that prevents you from coding this. The problem is that even though AI is so powerful, there are a lot of weak signals that your mind comprehends when you change time frames, when you check your other screens, how the market is moving with the market breadth, with the volume footprint. And I'm pretty sure some really good coders can come up with something that works automatically. But if you are discretionary traders like we are, you follow your strategy, and with discipline, with consistency, you make money. All right, so let's go and see. Here we go. Let me zoom in a little bit. Okay, so we trimmed. And again, what I'm explaining to you, you can check it out on our live that are in our YouTube channel, and you can replay. You trim here, you let run the rest. But now is the time to talk about the stop loss. You don't want to let your stop loss this high. You trimmed, it's good practice to trail your stop loss. Some people like to trail the stop loss just above the previous 5-minute candle. We used to do that in the past. But after a lot of backtesting, we finally came up to the conclusion that trailing just above the 20 EMA is better. And actually we will illustrate that in this move, as you will see in a bit. So at each level you have some sort of consolidation anyway. So you have a reaction here, okay? And then, boom, you trim more. You trim more. So at this point in time, you have a textbook perfect bear flag. And the opposite is true. If you have a bull flag, it works exactly the same. Right there, if you are not in a trade, I will argue that it's not the time to enter a new trade. You might be tempted to buy long to catch a reversal. At this stage, you have no clue, no signals that indicate a reversal, apart from the fact that it's really extended already. And that's why you don't want to take a short neither, because it's extended and because you already have one leg, two legs. And usually the moves work in tandem, always two legs. Sometimes legs are small, but always two legs. 1, 2. So now we want to see if a reversal will happen or if there is a continuation. And if there is a continuation, I can bet you that it will have two legs. All right, so you wait, you trade your stop loss, and you wait. At this point in time, you've secured already a decent profit, and your stop loss is somewhere here, so you can't lose. Your entry was there. You are in the driver's seat. That's crazy, that's awesome, that's the best position to be in. And usually when you are in this position, the only regret is, I should have sized more. I should have bought more contracts or more shares. In this case, it's a sell short. So, okay, so what's next? Some sort of consolidation at this level. Okay, and this is why you don't want to trail your stop loss at the previous candle, because you would have been stopped at here, or here, or here, or here. By trailing your stop loss above the 20 EMA, you are right there. Okay, your stop loss is right there, and you are not stopped out yet. Another rule of thumb is this descending trend line. We see that we have a pivot point here, pivot point here. This is a trend line. As long as you are below this trend line and below the exponential moving averages, you are in a downtrend. And you trim more. It's a crazy move. It's a crazy move. So now it's one leg, two legs, and we are in the third legs. Okay, a little bit of consolidation again, and move down. One more time. And you trim more. And this time it starts to be extremely extended. One legs, two legs, three legs, four legs. Okay, so here maybe you still have one or two contracts. Maybe that's where you decide to sell everything, or you trade your stop loss, but in that case you know that potentially you will have a reversal and you will be losing this amount. But that's fair, that's fair, that's fair. And actually that's what we did. Consolidation, and boom. Now we broke out of this descending trend line and we are above the 20 exponential moving average. Okay, so this move overall, someone who would have not trimmed at all would have made 10 times his initial risk, which is extremely good, extremely good. Okay, so that's the way we like to trade this type of patterns. Bear flags, textbook perfect. We had one this morning. I hope you made some money. I hope you got some value out of this video. If so, please subscribe, leave a thumb up, check out our other socials. Everything is free. We are not gurus. We publish alerts in our Discord. We did so this morning. And everything is free. We are not selling anything. Okay? We are just sharing our love for trading. And we started this day trading challenge to prove that with consistency, with discipline, with a set of rules and playbooks and strategy, if you follow, then you make money. It's as simple as that. All right? Thank you guys, and see you in the next one.